Good to see you both. David, on Steve's point about obviously the reversal in energy that we've seen, I'm looking at a JP Morgan report this morning. The title is Food Inflation from Boil to Simmer. How much of this do we trust?
So, I mean, first I'd like to address the point of, how much do commodity prices really matter to the Fed? And I think that when it comes to commodity-driven inflation, the Fed is very willing to look through that, right? It's important to remember that inflation measures rate of change. Inflation does not measure level, and it does seem reasonable to expect that commodity prices will come off the boil and perhaps move to more of a simmer over the course of the coming months. But, I think that there's another piece to this puzzle, which is that part of what's gone on here over the past couple of months, and we can see this very clearly in the Chase data, is that as individuals have been forced to redirect more of their spending to things like food and energy, we've seen demand for non-core goods and services begin to wane. That weaker demand is part of what I think has factored into the Fed's decision to get to neutral and then look around and see. And so I think this is going to be a moving target. Again, if people are spending less on food and energy, that means they have more to spend elsewhere, and perhaps that doesn't take inflation off of the boil quite as quickly as a lot of people had thought.
Michael, I wonder how you're viewing, how you're trying to frame or read FOMC policy in general, because they talk about, well, we can't let inflation expectations become untethered, but what about employment? What about the ratio of openings to unemployed workers? Some just say, you know what, we're going to watch gas prices, and that's going to give us the read on what the committee's thinking.
Well, Steve's point about the Fed being data dependent, I think is really important. But what's even more important is whether they're looking at incoming data, so realized data, or they go back to their old ways of looking at their own forecasts. So the next CPI report, the next reading on inflation, other than tomorrow's data on average hourly earnings, is likely to be very strong. We're expecting another 0.6 on core CPI and strength in the headline because of June's gasoline price increase. We know that things have come off, commodities have come off, and that includes the drop in gasoline futures to the tune of about 20% from its peak. Whether the Fed shifts back to looking at forward-looking measures like commodity prices or the incoming data is really important for the June meeting. We think they'll ease back a bit and, quote-unquote, only go 50 basis points, which is still a pretty strong move at the end of this month. But there's still a risk that they just rely on headline numbers that are incoming, not be forward-looking at all, and go 75.
Yeah, and if that's not confounding enough, David, there's some argue the spread between CPI and PCE is so wide now that it's kind of a choose-your-own-adventure story that might sort of freeze the Fed in action and keep them too tight for too long, depending on how things work out.
It's a question that we get all the time, and we're always trying to help clients better understand the difference between CPI and PCE. Importantly, the Fed prefers PCE as their measure of inflation. It's more dynamic. The weights are adjusted more frequently. CPI tends to be a bit stale, given that the basket is only revised every couple of years. And so I do think that the Fed will focus on PCE. But I think what's very interesting, and again, going back to the minutes, is the Fed is providing us with a sense that they are getting their arms around the broader situation. Carl, when we were chatting a couple of months ago, it was kind of like staring into the abyss. Does the Fed care about growth? Do they care about inflation? What's going to happen with the economy? Are we going to tip into recession? It feels like we're beginning to see things crystallize on the horizon in such a way that we know the Fed is prioritizing inflation over growth. We recognize that the economy is in the process of slowing. The question out there is whether we stall or simply slow. And I think, again, the Fed's going to be in a position by the fall of this year to react to the data as it comes through the door. And so we're watching PCE. We're also watching the way that things evolve from here, given that we've already seen a bit of a slowdown across the demand side of the economy.